Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Tuesday. It's May 3rd, and it's about 7:50 in the morning. Just can't sleep. Market's going to be opening up in about an hour and 40 minutes, probably a lot sooner by the time you get this video, but I'll try to get it to you as soon as it's processed because I know a lot of people like to watch them. And if you enjoy them, send me an email, support@marketgeeks.com. Would love to hear from you. Now, as you can see here, we're opening up down a little bit, not a lot. The Dow Jones is down 99 points. I just did an ATR study right here that showed our trading range. And if you look at our trading range, just to give you an idea, here. So you could see what the volatility is like. So let me make this chart a little smaller. It's kind of interesting, actually. So, oops. I got trigger fingers this morning. Okay, let's make this small. There we go. So as you can see here, this is the Dow Jones, and this is the Dow Jones over the last 9 months. And this is what the volatility was summer of last summer, about 299 points a day. Let's go a little further. You know, sometimes it'll go to 400, but it'll peak at 400 and then it'll come down to about 200. So it fluctuated from 400, say, to 200. But then, oh boy, look at the volatility since October. We go all the way down to about 256 points a day on the Dow. This is the volatility, the movement on the Dow. And we move high, and we move high. Every time we cool off to the 476, 400 level, we go back to the high 600s, which means the fluctuations, the daily fluctuations on the Dow Jones are averaging over a 10-day period about 675 points. Now, folks, I'm going to tell you something interesting. For all of you out there who are thinking bear market, when markets become bear, stocks become very listless, and there's not a lot of interest in them. When volatility picks up like this, that's a volatile market. That's a market that's in play. That's an opportune market. And again, I think we're bottoming out here, and I think we're going to go higher to the 200-day line, at least to the 200-day line. But the fact is, volatility is near 700 points a day. Can you imagine that? It's crazy. Now, in terms of this week's report, as I mentioned yesterday, we had manufacturing. We had two manufacturing report and construction spending. They were reasonable. The market rallied second half of the day. Today, we've got factory orders. But tomorrow, we've got international trades in goods and services and FOMC. We're going to find out tomorrow if, in fact, the Fed is going to raise rates and how much they're going to raise rates. Are they going to raise rates a quarter? Are they going to raise rates a half? Are they going to go all out and raise 3/4 of a point? That happens tomorrow. And what we're watching right now is we're actually watching the long bond, which is, let's see here, it's actually higher this morning. So my theory is the long bond has been kind of consolidating. Notice this downtrend, this real big downtrend. I think it's coming to an end, and I think we're going to go to a choppy period. If that's the case, that's the market telling the Fed we've had enough. That's enough raising rates. Because, I mean, look at this. The long bond went from 155 to 117. Now, this isn't the short term. They're raising the short-term rates, but we're looking at the reaction of the long bond, and the long bond may be done going down for a while. I mean, look at this, from 155 to 118. I'm thinking a little bit of an upside, a little choppiness, which would also give relief to stocks because bonds going higher relieves pressure on interest rates. Now, the big news, as I mentioned, tomorrow is going to be the FOMC. If the Fed raises rates, it's going to be a big pressure on the stock market, but it depends on what they also say and what they're expecting. I believe what's baked into the market is half a basis point. We'll see that right now. Nope. Let's see here. Prior 0.25 to half, 75 to 1%. We'll see. We'll see if they'll get there. But I don't think they're gonna raise more than a quarter. Even if they get to 1, that's only a quarter or half a point. So that's really what the expectations is. And then Thursday we have the OPEC meeting. But right now, everything is being driven by this FOMC, and tech stocks are extremely sensitive. Consumer stocks and tech stocks are extremely sensitive to the FOMC, so keep your eye on those sectors next 2 days, and keep your eye on the bond market. If it starts rallying today, that means it's already up 1 pre-market. if it starts rallying today and comes back into this range, it's telling us that the raise will be smaller than bigger. Now, we've got earnings highlights. Aside from FOMC, we've got earning highlights today. Today, we've got Pfizer coming out and AMD. AMD is going to have a major impact on chip stocks. Pfizer is going to have major impact on the broad market and the medical care stocks. Pfizer is looking at $1.49 per share, 59% year-over-year increase on revenue of $24 billion. That's 64% increase. Remember this number, $1.48. That's baked into the market. For AMD, they're looking at 91 cents per share. That's a 75% year-over-year increase on revenue of $5.5 billion. Aside from that, we've got, let's see, Big Five, one of my favorite sporting goods stores on the west side of the country. Biogen, that's a big one coming out. Caesars Entertainment, British Petroleum. Got a lot of energy stocks. Cirrus Logic, semiconductors, Comstock. Let's see here. Denny's, DuPont, Eaton. Big companies. Estee Lauder. Companies that we all know about. Extra Space Storage. This will be interesting. But there's a lot. Hilton Worldwide. We're going to get to know by the end of this week where we stand. We already have half of the earnings out. And so far, even though they're rotten, they're better than expectations. Public Storage reporting, Prudential reporting, Spirit. I thought it was Spirit Airline. Starbucks reporting. That's a big one. So you've got a lot of mixed bag reporting today. If you're interested in specific numbers, you can email me at support@MarketGeeks, and I'll give you the actual baked-in estimate. But there's a lot of stocks, so expect a lot of volatility. And then we've got the FOMC. In terms of global economy, I'll kind of quickly go through this today. There's not a lot of news. Oil fell. Oil and U.S. futures edged higher. Investors are expecting another rate hikes by the Federal Reserve, and other central banks accelerate efforts to curb inflation. We'll see how that goes tomorrow. They're expected to raise short-term rates by double the usual amount when it released its statement on Wednesday. We'll see. Ultra-low rates helped drive stocks to unprecedented highs during the pandemic, and now things are being reversed. On Monday, we had a nice turnaround by tech stocks, averting more losses following brutal April, which was a horrible month for stocks. Typically, it's not. Concerns about rising inflation is hanging on corporate earnings this week. As I mentioned, Pfizer, CVS, the big one, Kellogg's on Thursday. That'll be very interesting for consumer staples. I like Kellogg's. High yield makes bonds increase attractive. Assets relatively more risky and expensive, particularly tech and growth oriented. That's where we got to focus on. European energy ministers are up in arms in Brussels about Russia's supply in eliminating natural gas from Poland and Bulgaria, I believe. We'll be hearing more about that. But right now, the markets are being driven mostly by FOMC and by earnings. Now, let's take a look at some sectors. Energy is still leading. Consumer staples is still leading. Utilities is still leading. Basic materials is still leading. These are definitely the ones you want to focus on to the long side. To the short side, we've got communication and consumer discretionary, which I would be kind of cautious on right now. Financial, I would be cautious on. I would be cautious right now on the bears. So as far as the market, energy looks like it's starting to come up again. Consumer staples just had an awful day. We'll probably see a bounce after yesterday's downside. Utilities, boy, oh boy, utilities, because energy prices may be going down, utilities are starting to succumb. But I think we're right near our support level. Basic materials looks like it's done going down. The correction is done. Industrial, definitely. Technology, it looks like it's ready to go up for another fight. Real estate looks like it's going to bounce up. We actually look like we're going to bounce higher today. Healthcare sector looks like it looks like this downside pressure is overdone. With financials, it looks like it's this shakeout is overdone. Same thing with consumer financials. Everything is actually pointing higher, so I wouldn't be taking short positions right now. I would consider taking some long positions in energy. Let me show you which ones I really like right now. Energy, probably basic material and energy. I would be very cautious. I would probably put a little bit into consumer discretionary and tech because they look like they're bottoming out right now, and a lot of the data they're taking in is priced into the market right now. But as far as the most god-awful sector, it's still the communication sector. And if I have to guess, it may rally a little bit and then come back down. But I got to say, the market as a whole looks really, really oversold right now. If you look at the RSI, we're near the $31 level on the Dow. If you look at the QQQ, not only is the RSI low, but we're also seeing a major, major divergence. This is what I wanted to show you. Down, up. That's a low. It looks like we're going to go higher, kind of stick around this area, but I don't think we're going to go much lower anymore, which means volatility via the VIX is probably set to go down, not up. So keep an eye on that. Volatility, I'm expecting to go all the way to the $20 level. So I think the markets are going to be bullish, and I think the Fed has to be extra careful in what they're going to do. As far as going long, I really like the energy sector right now. I think the energy sector is heating itself up for another spike up right now. And as far as the worst sector, communications sector, folks, it's just god-awful right now. It doesn't have anything good. And even though it looks like it's bouncing, I wouldn't expect too much of a bounce. Probably stay away from the downside right now and focus on the upside till we get a little bit of a bounce. But as far as key upside sector, energy, downside sector, communication services, for sure. And on a monthly basis, if we look at it on a monthly basis, which we will, you will see that consumer staples is leading and communication services is lagging. And on a cumulative, consumer staples is number 2. So you can't really go wrong with consumer staples or energies or utilities. Any of utilities, I would hold off right now. Consumer staples, energies, or basic materials. Those 3 are golden right now. And again, energy, consumer staples, can't go wrong with those. Now, before I let you guys go, as many of you know, the markets have been in a bloodbath. I mean, let's just be honest with each other. Even though there's an upcoming event that could change everything for traders, many investors' accounts have been in the red, and no one knows what to do. Between the inverted yield curve, don't get me started on that. Many large stocks are down more than 40%. In the U.S., the GDP going negative this past quarter, these may be scary times. But folks, earnings are getting better. And earnings are actually starting to see some upside. Also, I think we're bottoming out right now. GDP showed that businesses are spending more money, so there could be some upside. But here's the kicker. Former $700 million hedge fund manager, Jeff Zananeri, he sees all of this as one of the biggest opportunities of the year. And he's going to share this with you. He predicts things are only going to continue getting more volatile for Wall Street. Click the link below to learn more about Jeff's prediction and how to join him. Do it now. Tomorrow, we're going to talk about one long, one short, actionable trade ideas. Follow the link below this video and check out what Jeff is on to. He's red hot right now. And he's been right on the ball this year. If you can't find the link, go to the YouTube Wealth Press channel. It's in the descriptor below this video. Hope it helps. Have a great day. Send me some love letters. Support at marketgeeks.com. I haven't heard from you in a while. Bye.